Hello everyone, this is your Retirement Resources Friday newsletter, and today I wanted to cover the effects of the unwinding of the Federal Reserve's balance sheet. That's kind of what's driving a lot of the stock market volatility, driving a lot of kind of our investors' woes, and figure out what history tells us, figure out what this actually means, what it's doing to the monetary supply, and I guess other things that we can kind of think about when we're looking at the tapering and how it's affecting our investments and how much we have actually in the stock market, and are there any other alternatives. So first, the unwinding of the stock market, the unwinding of the Federal Reserve balance sheet. So the first phase of the unwind begins with tapering. So to make things kind of timeline oriented for all of us, when we had the pandemic, what the Federal Reserve did was they purchased $120 billion worth of securities, of US government debt, mortgage-backed securities. And they did that $120 billion a month for quite a while. And there was some bigger purchases that happened. But if you look at this graph here, it kind of shows us what happened. So right here is when they began purchasing. We were at about a $4 trillion balance sheet for the Fed, and then now it's a little over $8 trillion. So they essentially expanded their balance sheet by $4 trillion. That's $4 trillion of, I wouldn't say imaginary money, but in all essence, it is imaginary money. They put it into the system, and now they're pulling it back out. So they're going to start pulling it out by first tapering the amount that they purchased. Now, when the Fed tapers, historically speaking, this chart here shows what happens when they taper. It's historical data, of course. So in May and June of 2013, they began tapering, and it didn't do the stock market very well. Right now, we're sort of in that phase because we haven't yet unwound the balance sheet. So as of June 30th, the maturity or their bonds that they purchased matured, and instead of repurchasing more bonds at that level, they're simply going to let it expire and not do anything with the quote-unquote profits that they would have realized. So that's how money is leaving the system. In addition, they're going to start selling back or letting $30 to $60 billion of assets expire. So this is how the Federal Reserve is going to unwind their balance sheet. They're going to start kind of letting these things quote unquote disappear from their balance sheet. And this is the rate: 30 billion in US Treasury and 15 billion in mortgage-backed securities. And then in September that goes up to 60 billion in US Treasuries and 35 billion of mortgage-backed securities, all the way until the end of 2023. So this still obviously has not happened yet, and the market knows this is coming. Whether or not it's completely priced in is yet to be determined, because we still have to deal with the bond market's kind of reaction. So the bond market is actually a larger market than the stock market. The bond market, as you can see here, the Fed owns $8 trillion of pretty much the bond market by themselves. It's not taking into any consideration of corporate debt, junk bonds, high yield bonds, savings bonds, everything else. This is just what the Federal Reserve owns. If you own a bond, you're part of this market that's even bigger than $8 trillion. It's probably, if you look it up, it's probably huge, right? So how's it going to affect the market when this huge buyer is no longer buying, but indeed selling? In addition to that, the credit spread between what corporate companies are actually being charged for taking out loans has risen to 1.5%, or 150 basis points. And when that kind of level breaks, now we have the problem of having corporations have to pay a lot more for borrowing money, coupled with the fact that the federal funds rate has been rising 75 basis points every quarter. That has really put a tightening kind of constraint on any companies looking to grow. So when you think about the stock market, it's not just about how much people are putting into bonds versus how much they're putting into stock versus what they think the economy is going to or output, there are things like this. Internal companies have to kind of now figure out not only how to deal with a contracting economy, contracting consumer spending, they also have to worry about contracting or expanding expenses from an expanding interest rate environment, right? So all these things to kind of consider. So what has history told us now about when we unwind? Well, when we unwind, the stock market is relatively flat. No real big swings in either direction. We have almost a 70 basis point increase between 1 year or one quarter to the next, and then negative 30. So all in all, it's choppy. Nothing amazing happens and nothing too detrimental happens. But this is, of course, again, past data from 2017. And if you can think about it, 2017, the unwinding took place way after the event being the 2008-09 crash, right? So they waited a long time, almost an entire decade, before they really started to I guess half a decade. It started in 2013, and I guess it started kind of in 2008, so that's 5 years. But they didn't finish unwinding until September of 2017, which is about 9 years later. And they did it really slow. And they kind of went back and forth. And some months they didn't raise it at all, right? They didn't raise it at all. So our market the interest rate's being risen or being rose by. Sorry, English is not my forte. The market is pricing in 75 basis point rises every single year or every single quarter. And I'm just going to pull up a chart here on the SPY just so we can see how we are Friday. We're up today. Barely. We were down earlier this morning and now we are up. And I believe that it's primarily because we got smashed so hard over the last kind of this entire week. So we're kind of going back into a tightening range, expecting more data to come out. One of the things that none of us have really considered is that the Fed actually hasn't stopped buying the bonds. Well, they haven't started dishing out all of their securities onto the open market just yet. Remember, they're not going to do it really until September. That's when the big amount of money will start to come out. And in all honesty, I mean, when the bonds mature at the end of the month, this is pretty much what it means. Yesterday would have been the first day that the Federal Reserve didn't come and purchase or be neutral. They're now trying to get rid of it. They're not renewing their debt, and that causes a gap between how many buyers and how many sellers there are. If there are not enough buyers, it's no problem really, because corporations start trying to get rid of their bonds so they can price it better. But if there aren't enough buyers, then we could have a liquidity issue. Now, how can we have a liquidity issue in a market that's so huge, right? Trillions of dollars of bondholders. Well, if no one has any money to buy these bonds, then the bonds will not get purchased. And then we'll have a lot of debt that's unserviced. We have a lot of debt that's maybe spread-wise would be more expensive. Maybe you have people who have positions they don't want to get out of. It might not make sense to retail investors who have access to Webull and TD Ameritrade and E-Trade, and you can just kind of buy and sell, and it's pretty simple. But imagine if you're trying to move $1 billion off your balance sheet, and you're trying to sell it for $1 billion, but there's no buyers. Now you gotta lower your ask price, right? Maybe $900 million. No one can afford $900 million, right? So you got to keep going down and down, and that's the problem that a lot of people start seeing when those kind of the market liquidity is in question. And it looks like right now anyway, the market liquidity is about at the point it was when we were having our pandemic woes. So if the bond market gets kind of trapped, then that could cause our stock market to just falter right there, simply because that's a lot of money that's being kind of stuck and tied up. And without the Federal Reserve to kind of give relief in the form of, number one, buying some of these less desirable securities, but also by driving up the cost to borrow, making it more expensive or a lot harder for institutions to kind of push in more liquidity themselves, it makes kind of a bad environment for anyone bullish on the stock market. So what can you do? What are things that can help in this circumstance? Well, I did a video, I think I might have talked about treasurydirect.gov. Not supporting, not recommending you to do anything. But what I did was I put just a portion of what I would have normally put into the stock market into an I bond. And right now the I bonds, the inflationary treasury bonds backed by the government, is paying 9.62%, I believe. And they pay it semi-annual. So if the rate changes in the next, they change their rates, I believe, in November and May, something like that. But the declared rate changes twice a year. Right now it's at 9.62. If I only get half of that, that's 4.81. Not a bad deal for risk-free, right? There's no risk in it. Now the bond does have some, stipulations. You have to hold it for at least a year. If you redeem it before 5 years, then you give back a quarter of the last kind of month's interest, or last half a year's interest. But I mean, for me, it's a good alternative for just setting aside some money. That's kind of, right now, stock market's really choppy. I do have my normal positions that are already in the stock market, but I'm not going to change any of that. Just the new money that's going in. So if you did have new money you're thinking about investing, I would look towards other things. If you have a whole lump sum amount of money, then there are other things that are not really tied to the downside of the market, but tied to the upside. But that's not for this video. But anyhow, that's what I think is going on. Retirement update for July 1st. Happy 4th, and I'll see you guys in the next video.